So this being our first class, I welcome you to our new journey under the advanced level, where we are going to be covering advanced financial management. But most importantly, I just wanted to go through our content and we look on what is the expectation, what are we supposed to be going through during our, I think it should be a short semester. Like any other, they are always short. Since CASNEB introduced our 3 sittings in a year, so a lot of concentration and participation is mostly required, as we know the magnitude of our paper which we are starting to engage today. So you will just be able to participate by, if I give out the assignments, just be ready to do your assignments. Share with me for marking. That is how I will be able to know if we are on the right direction. Number 2, I don't want us to start revision from August. Our revision will start today. So I'm expecting to see a lot of engagements through our videos, which we are going to be sharing with you. So I want to see engagements, concentration, because I don't like my student failing. It is my hope that this journey which we are commencing today, we will be in a position to do what is necessary and achieve our objective. So basically, we are going to be starting from a topic. I think there is a student called Chacha who was able to ask me, Mwalimu, the notes which you are sharing indicate that we are doing FM section 3. It is not FM section 3, but we pick from where we left. That is the advanced capital budgeting decisions. And in this scenario, we understand that the capital budgeting is a topic that we tackled there before. And basically, it talks about some of the investment decisions which are normally made by organizations. And we know very well that the capital budgeting decisions on how the firm should invest in long-term projects so as to maximize the shareholders' wealth. The most important aspect is that we know majority of us, we are investors. And we have invested with the highly generating organization in terms of the profits. And in that circumstances, we know we are going to be playing with the aspects of the percentages or the proportions or the weights based on the decisions which you are going to be making as individuals. So also the organizations normally make decisions. And we normally find that such decisions are normally made by the organization, maybe one, for the expansion of the existing projects which the organization needs to undertake. Number 2, there must be a case of the replacement decisions. And this normally we are going to be reverting from where we left in terms of the investment techniques, which we read under the capital budgeting section 3. Where we were able to tackle about the traditional and modern techniques, which are basically used in decision-making criteria. So in this case, when we are discussing about the replacement decisions under the advanced financial decisions, management, we are going to be discussing about the replacements of the machines, which we normally do when we are tackling our net present values. I know we remember where we are coming from. The other aspect of the decisions which we are supposed to be making under the capital budgeting, it should be undertaking a new project or the product line. And basically, when we are looking on the aspect of undertaking a new project as an organization, we have to do a product life cycle. And I know majority of us, for those who are under the whole syllabus, they were able to study advanced management accounting. It was important during those days, because it used to incorporate a topic called the decision theory, which when you see under your, when you look on your content, there is an aspect where we are discussing about the techniques of handling risk. And this we are talking about the basic methods of analysis, where we are discussing about the expected monetary values, the standard deviations, and coefficient of variation. That information is mostly discussed under the decision theory, under the advanced management accounting, for those who did it there before. So in this aspect, we know very well, when we are discussing about the decision theory, we used to talk about the aspects of the management accountants, and we used to say that the accountants are normally expected to produce the right information to the right people at the right time with minimum cost. And we know that every time you are going to be borrowing an idea from the management accounting, we are going to be discussing an aspect of the minimization of the costs. I just wanted to analyze our syllabus in that manner. Every time you are going to be borrowing anything from the management accounting or anything that is going to be involving investment, we have to be looking at, are we reducing the cost? And then we also look on the aspect of, are we maximizing the profits? Those are the things that we are going to be taking on. And I remember during that time when we are looking on the decision theory, we used to discuss about the types of the decision-making environment. I just want to just give an overview of where the expected monetary value comes and standard deviation and coefficient of variation. And in that aspect, we used to have four types of decision-making environments. We used to have environment of certainty, environment of risk, environment of uncertainty, and we used to have environment of competition. But most probably, and most importantly, we used to study under the advanced management accounting, we used to study three decision-making criteria, environment of certainty, risk, and uncertainties. We don't much engage on we don't engage on the environment of competition. So the information that we want to borrow from that information I'm giving you is about the expected monetary values. And when we are going to be hearing about the techniques of handling risk, we are going to be looking on when the organizations are going to be making any investments, which involves returns, there must be a risk involved. And that risk involved is going to be measured by the expected monetary value, the standard deviations, and coefficient of variations. Now, when we looked on the environment of risk again, we talked about the outcome of an event cannot be predicted with statistical confidence, right? But we said, but the states of nature can be assigned probabilities, because every time you're going to be involved in risk, there must be in other topics like the topics which you are going to be, the portfolio theory, which the students wanaogopa kidogo, involves a lot of probabilities. In other aspects, we normally discuss about weights and proportions. In that aspect, we are going to be elaborating much about how are we supposed to be using that information as the portfolio theory to make decisions. But let us come back here. So when the probabilities are involved, it means there must be a risk. And we say that decision-making process, when we are involving a risk, is based on the expected monetary values and opportunity losses. So when the expected monetary value is used, we used to say that the different payoffs, right, are given or are expected to be calculated. So the decision-making process is based on the highest or the highest. It is normally based on the expected. Sorry, it is normally based on the highest expected payoffs. For example, I just give an example of our production organization. We are proposing to introduce 4 products, right? And when we are looking on the product life cycle, we have to be looking on the product that is going to be giving us the highest return. That is why we are saying that when you are going to be using the expected monetary value, I will just give a simple example on my board later on to see how the expected monetary values normally make decisions, right? how are we going to be incorporating the standard deviations and the coefficient of variation? But to involve the two and to cut the story short, I will just give an elaborative aspect of the decision making when we are using the standard deviation and coefficient of variation. I will just be able to say that the higher the standard deviation or coefficient of variation, right, the higher the risk. When you are going to be comparing different projects, different products, right, we are going to be making the decisions by looking on the standard deviation of each product, and then we make a decision. So we are saying that to advise the organization, we have to calculate the standard deviations or the coefficient of variations. I will just be able to attach that based on the small information which I will be able to provide to you later on. Now, let us look on bullet number 3, where we are discussing about the advanced methods of analysis. And in this case, before we read there, I just want to concentrate on bullet 1 and 2. We are going to be involving and taking you back on the computations. I will talk about the computations of the techniques which we read under section 3. We used to have internal rate of return, right? Accounting rate of return, payback periods, discounted payback periods. We are going to be looking on the net present values, profitability index, and also we used to talk about modified internal rate of return. I know very well that we covered that type of information when we are doing section 3. And that is what I'm expecting we do tonight, right? And we see whether we will be able to complete the computations by looking on how and the shortest way of the computations of the net present values, which is the most method used under the advanced financial management. This method was tested even last semester, right? It means it is most of the powerful method used in the decision-making criteria. And when I will start doing it, I want us to be very, very keen by looking on now the computation in the simplest way we should be approaching in computing it. Now, let us look on the advanced method of analysis, and I will just be able to touch some of them. We normally have sensitivity analysis, scenario analysis, as you can see under your content. We normally have decision tree analysis, simulation analysis. I know we have tackled it somewhere on our roads for those who did quantitative analysis. We normally have utility analysis, risk-adjusted discounting rates, certainty equivalent method, which was tested under the December 2022 exam. So it means that we will be able to involve all this information when we are computing when we are tackling our syllabus, and I will be able to assist you with a very elaborative notes based on the areas which we are covering as we move forward. So in most cases, I will be able to give a typed notes based on the specific areas which we are going to be tackling as we move on. Let us look on bullet number 4. We normally look on the impact of the financial on investment decisions, and we look on the concept of adjusted present value. I remember there is, if it is not August, December, there was a question for APV, which was tested. We shall be able to do all those questions with you. Bullet number 5, we are talking about incorporating capital rationing in capital investment appraisal, single period capital rationing with divisible projects, multi-period capital rationing with divisible capital investments. I know very well that a student might be asking, what is a divisible project? And we normally say, these are the projects which can be undertaken, which can be financed together, right? Using the available resources, right? The capital rationing basically talks about what we can be able to afford in simpler terms, and based on the initial outlay of the projects, the initial cost of undertaking a certain project. So indivisible, it means we cannot be able to invest we cannot be able to incorporate a project which is not fully financed. And those are the terms which I will be able to use when we are going to be tackling the capital ratio, because I know under the last semester's question, it was already incorporated in a certain question. So in that aspect, we'll be able to discuss much about it. Now, we are also going to be incorporating inflation in capital investment appraisal. And I will just be able to give a direct example regarding to inflation aspect in decision making. Today, I am hearing that the inflation rate is affecting all the prices of the commodities, and it is going to be involving an aspect of reduction in the purchasing power. That is what the inflation is all about. So when the inflation is high, there will be an increase in the nominal revenues and costs. However, the cost of the capital and debt obligation remain unchanged. And in this case, we normally, because I just want to analyze the aspect on inflation, because I know it is the discussion of our today's topic in regards to our economy, we are saying that when making investment decision under conditions of inflation, there are only two alternatives adjustment that can be done. And in this case, we normally look at adjust the cost of the capital for inflation. How are we going to be doing that? We will be able to see it when we are doing when we start analyzing our topic. Then number two, we are going to be looking on adjusting the net operating cash flow in each year of inflation. And we are going to be looking on the both approaches based on the expected information provided based on the net present values and the effects it has. So I'll be able to give comprehensive illustration. We're going to be giving out elaborative info regarding to that. Now, the other thing that we are supposed to be looking at, it is evaluation of the project of an equal lives. And in this case, we are going to be using a concept of the equivalent annual annuity approach and the replacement chain analysis. And in that aspect, we are talking of constant scale finite period replication criteria. And in most cases, I know you will be able to ask me, what is this all about? And I'll be able to say that when you look on the aspects of evaluation of the project with an equal lives, there is a question which we shall be able to do under the under our past papers, discussing about an equal lives and elaborating every aspect regarding to an equal lives. It means these are projects which they don't have the same periods of undertaking, and in that case, it means they have an equal lives. And with that is where we are saying we are going to be using a constant scale finite period. Finite period, it is a period which we can be able to utilize in the completion of our project. Now, the second last point of discussion in this topic, and you can see it's a very wide topic, but it is mostly tested topic. We are going to be analyzing the project duration as a measure of risk, right? Because, you know, when we are discussing the project duration, then we have to be incorporating the payback periods of a project. And that is aspect whereby the examiner normally tells you in an exam, can you be able to make a decision where you are going to be using a payback period, right? And we normally say that a payback period is a duration in which a project has to undertake to return the initial investment. And in that aspect, we normally say the shorter the period, the better the project. So those are the terms which we are going to be using under the project duration measure. Then number 9, we are going to be looking on the real options in capital budgeting characteristics of the real options. We are also going to be looking on the types of the options in capital investment appraisal strategic investment option. Timing option, when are we supposed to be abandoning a project? That is why we are talking about an option to withdraw projects. We are also going to be looking on the replacement option and the option to redeploy a project, and the challenges in use of options in investment analysis. Then the bullet number 10 and the last one, we are going to be discussing about the common capital budgeting pitfalls. So those are the things that we are supposed to be looking at under topic number 1. And that is why you see, I was able to share these notes. These notes elaborate, they are the same notes which we used under the financial management, but basically we are borrowing that concept to build a base of our introductory of advanced capital budgeting decisions, because we are borrowing that topic a lot. Now, in this aspect, we are saying the capital budgeting refers to the investment decisions of a firm. And I remember this is the information I gave you earlier. We are saying that the decisions on how the firm should invest in the long-term projects so as to maximize the shareholders' wealth. Let me see, there is someone who is able to greet me. Emily Commander will be able to do that with you. Now, we are saying such decisions may include 1, right, expansion of an existing project. We normally have replacement decisions, undertaking a new project, which is basically the same as the product line. We are also talking about the research and development activities. And under the research and development activities, we know it is our first stage of our product life cycle, whereby we are trying to introduce a new product in the industry. And in this case, we first have to do or look on the gap in which we have to bridge. So that is why the research and development is mostly important. We have the challenges of investment decision in the real world, and I will leave those ones to you to be able to check on them. But before I engage, because the most aspect which I just wanted to borrow here, it is the techniques, the investment appraisal techniques. These ones are basically tested, and the most, I just want to look on them, which are basically, and which we were able to see. If we are repeater, you can be able to bear me witness. When you look on the payback period, mostly tested under your level, together with the net present values, we also have to learn much about the internal rate of return, and we know how we used to do it, the profitability index, but those are the basically most important criteria which you need to understand very well. They are mostly tested techniques under the capital budgeting. The payback period, net present value, IRR, PI, and then the others we just need to cover them up due to the issue regarding to uncertainties of the exam. We know how the CASNEP normally test the exams. Now, before we engage on that, I will just be able to share my board so that I can give out some of the concepts regarding to 3 concepts under our bullet number 2 in our content under topic 1, before I engage on the investment appraisal techniques. And this aspect is based on the methods which are the basic method analysis which are used under the capital budgeting and which are incorporated under the advanced financial management. It is the expected monetary value. I have explained and elaborated it much. The standard deviation, which I've already elaborated also much. And also the other aspect we are supposed to be discussing is the coefficient of variation. Those are the first things that I just want to do. Then after I complete introducing them, because I know that information, we shall use it as we continue with our syllabus. We will be able to borrow that information somewhere. I will just be able to give out a simple illustrative method, then, example, cover the 3 scenarios, then we move to the investment appraisal techniques. I request you to allow me to do so. So in the meantime, I request that you have a paper or a book which you are writing. You have a calculator by your side, by the way, so that I will be able to give you time to copy, right? You have to be copied. Sometimes students, in the previous classes, they used to tell me, Mwalimu, you are too fast. I don't want to be too fast with anyone now. I just want to go slowly so that I need you to understand more, right? But the slowness will not mean that we are not finalizing the syllabus on time. I have to give you a period of 20 to 25 days, by the way, to read on your own. So it means the syllabus has to be covered before July end. So that is what I just want to do. In meantime, I think my board is visible. You can be able to see it. My board is visible. Can you be able to see it? You can leave your text on our chat box. Can you be able to see it? Can you be able to see our board? Just waiting to see. Is my board visible? That is what I'm asking now. Very good. I'm seeing a response here. Let me see from who. Yes, from Chacha. I think everyone is able also to see it. So this is our topic number 1. Topic number 1. That is our topic number 1. The advanced capital budgeting decisions. And in this case, I have elaborated it much. But what I just want to look at it is when we are incorporating something called the, when we are dealing with the aspects of, there's normally called incorporating risk, uncertainties, right? Let me just write it here, and we write with me. So incorporating risk, we want to look on the incorporation of risk, stroke, uncertainty, in capital investment appraisals. Capital investment appraisals. Capital investment appraisals. I just want to start our topic from that point. And when we are discussing about a capital investment appraisal, we are going to be looking on 3 scenarios. They are normally called basic tools of analysis, right? They are normally called basic tools. I remember this one I was able to elaborate in our introductory part of our analysis of our topic 1. So the basic tools analysis, which you are going to be using, right? Number 1, we are going to be having expected monetary value, right? It's normally called EMV, correct? Number 2, we are going to be using standard deviation under our analysis on decision making, which you remember, there is a sign which is normally looking like this, which normally means the standard deviation. Then number 3, we normally took a look on the coefficient of variation. Coefficient of variation. It is normally called CV. So in this case, you will just be able to give me a 1 minute to explain about each. So when we are discussing about the expected monetary value decision making, we are saying that the different payoffs are used in decision making. Different payoffs are used in decision making. Right? And a payoff with the highest, expected return, the payoff with the expected highest return is selected. So it means under this expected monetary value is mostly used in your question or in your syllabus. It means that we are going to be having different payoffs, and these payoffs are going to be used in decision making. So in this aspect, it means we have to be understanding how am I going to be incorporating the expected monetary value. It means there must be probabilities. There must be probabilities, right? Then we must be having different projects. Different projects. We are going to be having different projects, right? Maybe project A, B, C, D with different payoffs. And then we are going to be given, for example, let me talk about NPV, the net present value, which is what we are going to be reading next. Or we are going to be given cash flows of each project, the expected cash flow of each project to make the decision under the standard or the expected monetary values. That is one key. Number two, I will be able to look on the aspect of decision-making criteria using the standard deviations. And we need to understand that when the standard deviation is the basic root of a variance, right? Let me just put it here, is a basic tool, or we can be able to say it is basically the square roots. It is basically the square roots of variance, right? It is normally the square roots of a variance. So this is just a quantitative measure. I just want to explain it. It is just a quantitative measure of the variation expected around the expected values. So basically in this case, it is the measure variation around the expected net present value. I remember very well when we are looking on the standard deviations there before, we used to say to get our variance, we used to take, right? We used to take the summation of x minus x bar squared, right? X minus x bar squared, then we multiply by probability. We multiply by the probabilities. This one is not going to be used under the advanced financial management now. Why? Because most of our decisions which we are going to be making, we are going to be using the net present values. We are going to be using the net present values. So what is our formula now for the variance under the advanced level? I will say to get our variance in this case, we are going to be taking our summation of, we talk about NPV minus, we normally calculate the expected NPV squared, then we multiply by our probability. We multiply by our probability. Most of this information basically is under the portfolio theory and analysis. I just want to reach it there and I leave it at that point. We shall be able to expound it much when we are going to be looking on the aspects of portfolio theories. Now, let us go to note our number 3, which is a basic tool of analysis, and which is mostly or commonly we are going to be using. And we are saying it is the relative measure of risk, which is quantitative in nature, all right? Which is a quantitative in nature. And we are going to be giving out the basic scenarios on how we are supposed to be making the decision using the tool. So let me just write for you, and I say it is a relative measure. It is a relative measure. It is a relative measure, right, of risk. Right, it's a relative measure of risk, which is quantitative measure. Which is a quantitative measure. Which is a quantitative measure. Which is a quantitative measure of risk. Of risk per unit. Let me just reach out to that point, right? But here we can be able to say, right, to save us and understand on how we are supposed to be making a decision, we are supposed to be saying the higher the standard deviation, right? The higher the risk. Let me put it in this way. The higher the risk, the higher the standard, the higher the standard deviation or coefficient of variation. That is how it should be. The higher the standard deviation, the higher the standard deviation or coefficient of variation, right? The higher the risk. So how are we supposed to be making our, in our case here? We know that the project with the lower, this means the project with the lower risk, with a lower risk, is selected. The project with a lower risk is basically selected. That is how we are going to be incorporating the two in our decision-making criteria, So in this case, I just want to do a very simple illustration so that you can be able to understand how we are supposed to be covering the three. So that when you come across a question which incorporates the three, right? And there's a question of NPV, you know what you're supposed to be doing. So let me just give a small illustration here. Let me just rub here. I think I'm not too fast. I'm not too fast. So you can be able to stay there. Mwalimu, you are too fast. All my speed is okay with you. So let us go to illustrations to look on the basic tools analysis. Let us look on that illustration. It is a small one. So let us say this. I just wanted to understand these concepts. And we say, support a capital investment. Suppose a capital investment. Suppose a capital investment is expected. A capital investment is expected to generate the following. It is expected to generate the following NPVs, net present values in different states of nature. In different states of nature. That is our illustration. Suppose. So what are our states of nature? Very quickly, we state our states of nature are given here, which are, we have boom, we have average, correct? And then we have recession or recession. Then our NPVs are given for each state of nature. The first one in millions of shillings, by the way. So the first one should be 5. Here we have 2. Let us here have -3 or -5. Let me just put -5 here. Correct. So the probabilities of each state of nature are given here. So the first probability will be how much? We have 0.4, right? We have 0.3, 0.3, 0.3, 0.3. Then the required here, we say that determine the net present value, determine the expected present value, determine the expected NPV, determine the net, and advise the management accordingly. And advise the management accordingly. So every time I hear about give me the expected, you are already given the NPVs. Then the examiner answers the expected. It means we have to be incorporating our probabilities to look on the expectation, because these are the probabilities of the states of nature. So to get our expected NPV, let me just use it here, the expected NPV. To get our expected NPV, we just need to take our net present values, we multiply with our probability. So I just need to multiply. There. So the first one, when I do my multiplication, right, it means I'm going to be getting 2. If I'm not wrong, this should be 2. This should be -0.6. Then the last one should be -1.5. right? Negative 1.5. So how much is our summation in this case? How much is that? How much is our summation for the expected present value? You can see that is 2.6 minus 1.5, we get 1.1 million. What have we done, Chacha? We have done this. To get our expected net present values, we have taken, right, our NPV of boom. We have multiplied it with the probabilities of boom, plus we have taken the NPV of A. Let me just use letter A for average. We have multiplied it with the probabilities for A, right? Plus, we have taken the NPV for recession. We have multiplied it with the probabilities for the recession. That is what we have done. That is what we have done, right? Then I can see the examiner is saying that advise the management accordingly. So when we are doing our NPV acceptance criteria, the NPV's acceptance criteria, it means that when we are going to be the investment appraisal techniques, you will allow me to start with the NPV because to meitaje sana. So in this case, we normally have only 3 acceptance criteria. Number 1, we normally say, right, when the project is positive, right? When the NPV, let me just use the word NPV. When the NPV is positive, we normally say accept the project, right? Number 2, when the NPV is negative, we normally say reject the project. I know now we are together at that point. Then number 3, when the NPV is 0 now, we normally say the project may be accepted. The project might be accepted. Those are the NPV acceptance criteria. So when I have a question like this, I can be able to say, right, we can be able to say this, that the project should be accepted. The project should be accepted, right? Since our NPV is positive. Since our NPV is positive. That is one of the criteria you have to use. Number 2, I just want to incorporate the calculation of the standard deviation here. The calculation of the standard deviation, that is number 2. If the question was brought in this manner and you are asked to calculate your standard deviation, we said to get our standard deviation, we normally take the root of variance. We normally take the root of variance. And we said our formula for the calculation of our variance, because we are saying the root, we are supposed to be taking the summation of NPV minus expected NPV we square. Then we multiply by our probabilities. Hii ni a lot of information tutatumia sana when you are going to be calculating our portfolio theory and analysis. Portfolio theory and analysis. So to do this question, I will just be able to borrow this information here, and I will be able to say, to calculate my NPV in this scenario, how am I supposed to be doing it? I will be able to take the first scenario for boom. We say our NPV is 5 minus 1.1, which is our expected NPV squared. We multiply by our probability of 0.4. Now we go to the average, and we will be able to say our average is 2 minus 1.1 squared. We multiply by the probability of hours of 0.3, right? The other one will be the recession, which we shall be able to take negative 5 minus 1.1 squared. We multiply with our probability of 0.3. 0.3. What is our summation? That is why I requested you to have your calculator. I have mine. Where is yours? So in this case, the first one will be 5 minus 1.1. Then we square, we multiply by 0.4. Someone should be shouting the answer, which I'm getting is 6.08. Let me just put into 2 decimal places. The second one will be 2 minus 1.1 squared. Then I multiply by 0.3, getting 0.24. Then the third one will be negative 5 minus 1.1 squared. Then you multiply by 0.3, and I'm getting 11.16. What is the total here? And we'll be able to find our total is plus 0.24 plus 6.08. My answer is 17.48. 17.48. That is our variance. This is not a standard deviation. This is our variance. So in this case, to get my standard deviation, what do I need to do? I just need to take the root of 17.48. 17.48. How much are we getting now? How much are we getting? I'm getting something closer to 4.18. 4.18. I think we are in agreement up to that point. Now, number 3, we are saying we can be able to make, right? We can be able to make our decision based on the coefficient of variation. Coefficient of variation. I remember the last time when I was studying, when you are studying, for instance, you are studying what? You used to study quantitative analysis. You used to say, to get the coefficient of variation, you used to take your standard deviation, you divide it by mean, then you multiply by 100%. Multiply by 100%. Now, what about our scenario here? It means it is not going to be changing much, right? Why? Because you are going to be taking our standard deviation, you divide it by the expected NPV. Then you multiply by 100%. The standard deviation, you divide by the expected NPV, you multiply by 100%. So what will be our coefficient of variation from our example here? So in a simpler terms, to get our CV, we are going to be taking our standard deviation, which is 4.18. You divide it by the expected NPV, we got 1.1, right? Then you multiply by 100%. What is the outcome? What is the outcome there? So 4.18 divided by 1.1, then I multiply by 100%. I'll be able to get something closer to 380%. That is your coefficient of variation. That is the coefficient of variation. We are just having one project. Where are we going to be comparing to determine the higher the standard deviation and coefficient of variation? We are supposed to be given 2 projects with these states. The states of nature, you have given NPV of project 1, the probability of project 1, then you go and be given project 2 with the states of nature, NPV, probabilities. Then you are going to be comparing. So when I will be able to make my decisions, I will be able to look my standard deviation for project 1, and then the NPV for project 2. The one with the lower NPV, standard deviation, sorry, is going to be selected. The one which is going to be having the lower coefficient of variation is supposed to be selected because it has the lower risk. It has the lower risk. That is the information I just wanted to give you under the bullet number 2. I request now to engage on a very serious areas which are mostly tested under topic number 1. And those are investment appraisal techniques. Investment appraisal techniques. So let me just borrow from our financial management. So in this case, when I look at it, I was able to elaborate about our investment appraisal techniques, right? We said we have not discounted cash flow techniques, which you can be able to see there. And then we also have discounted cash flows which you can be able to see them there. But I said, can we be able, because we don't want to waste time. We just want to do the important areas, correct? Where am I going to be starting my analysis? Straight away, I have discussed about NPV. So let me just go straight away to NPV where it is, which is here. And it is one of the, when you look at it, we have said it falls under the discounted cash flow techniques. And we have said, this technique considers the time value of money. Very encouraging. By discounting the cash flows, they normally include, one, we are discussing about the net present values. And we remember very well we said that the NPV is the difference between the present value of the cash inflows, what the project is generating, minus the present value of the cash outflows, which is basically the initial costs, right? And we said cash flows are discounted using the firm's cost of capital. Sometimes we might be using WACC. And we said that in the computation of the NPV, and this is the information I'm borrowing from financial management, because we have done it, all of us. We normally have 3 stages in the computation of NPV. One, it is the component costs, right? The components of cash flows. And that is what basically under the different lecturers, we used to call it the initial outlay. Number 2, we are going to be looking on the aspects of the annual after-tax cash flows upon your time value for money in a given year. Then lastly, we are going to be looking on the terminal cash flows. Let me just explain much about the time value of money. I will be able to see that the time value of money means the determination of the future value, which we normally use compounding, and the determination of the present value, where we normally use discounting. Now tumeanza kuingia kwa financial management very well. So what is the determination of the future? It means I have certain cash flows today, right? Which I need to determine the how much am I going to be getting at the end of a certain period. So in that scenario, to determine in that case, you need to have the growth rates or the rates, discounting rates, or sorry, compounding rates. We need to be having the periods. So if I have 100 shillings today, how much am I supposed to be having in the next 5 years? So there must be a growth rate and a period. That is the determination of the future value. Then the determination of the present value, it means that I have a future figure, for example, 1 million. And then the examiner wants to determine our present, right? Determine our present. That it means we need to do discounting, correct? I will be able to teach you those basics. I know they are very important under your studies. They are very important. So in this case, we need to be analyzing the investment techniques appraisals used. And one is our NPV. Let us get back to our board. Let us get back to our board and we look on the strategy applied. So in this case, because we are looking on the investment appraisal techniques, investment appraisal techniques, right? We have said they are categorized into 2. One, we normally have traditional techniques. The traditional techniques is grouped into 2. We have said it is normally grouped into accounting, rate of return. This is ARR. Secondly, correct. Secondly, we normally have payback period. I said it's normally called PBP. This is not tested. So, I will not be able to do that. Number 2, we normally have modern techniques. The modern techniques normally comprise the following. 1, we have, I will start with the most common, the net present value. The net present value, right? The second one, we normally have, we are looking on the profitability index. This is normally called PI. This is our NPV, correct? Here, we normally have modified internal rate of return, modified internal rate of return. Is normally called MIRR. Okay. The other one we normally have what? We normally have discounted payback period. Discounted payback period. It is normally called DPBP. Discounted payback period, right? Who can remind me the last one? Which is our last one? Which is our last one now? Who can remind me the last one? Do we have the last one which we have forgotten? Someone? Yes, we have forgotten the internal rate of return. The internal rate of return, which is our IRR. Let me see. Someone has said something. Correct. Correct, Ali. Correct. So the modern techniques, we have 5. The traditional techniques, we have 2, right? But Mwalimu will be able to combine the payback period together with the modern techniques when we are doing our illustrations. And I will be able to do our illustration based on the mode of urgency, right? Which one we need to know most, right? That is how I'm going to be doing it. And in this case, I will start by doing the net present value. And we allow me to give you the summary methods which you're supposed to be using when you are calculating your payback period. I just want you to give me, to allow me to give you the shortest one. You don't want to kwenda kungaria examiner that you know how to calculate the NPV, no. I just want to show you the simpler way to calculate our net present value. I know you have already copied up to that point. I know you have copied. I know you have done your assignment there. I know you have done your assignment up to that point. Thank you. Now, let us continue. Let us continue. Now, in this case, I have said, I will be able to start with the first method, which is mostly tested, and it is normally called the net present value, which is our NPV, And the biggest question should be, how am I going to be calculating my NPV? How am I going to be calculating the NPV? And what does it mean? Now, in this case, I have said in a simpler term that NPV, it is a difference. NPV, it is a difference between the net present, it is the difference between the value of the cash flows and the initial outlay. I think that one can be able to make a bit of sense. I said it is a difference between, right, between the present value of the cash inflows, right, and the present value of the cash outflows. The present value of the cash outflows. And here is where we are talking about our initial outlay. That is where we are discussing about our initial outlay. So in this case, we have said we normally have 3 stages when you are computing our NPV. The first stage should be, the first stage should be our initial, the computation of our initial claim. And when we are computing our NPV, right, when we are considering to do our investment in year 0, we are going to be just having 2 columns here. And the following things normally qualifies. So we have Kenya shillings there, and we have another Kenya shillings there. Correct. So in this scenario, we are going to be looking on the cost of machine. Right? And mostly we are going to be dealing with machines here when you are doing the NPVs. So the cost of machines we normally put half there. Then you normally have, you add incidental costs. Incidental costs normally comprises the following. The first one should be installation costs. We normally have installation costs, which you normally put them here. Yeah. The second one would be import duty. We put it here, right? The third one will be the freight charges. We put them here. Then we normally have commissioning costs. Commissioning costs, we put also them here. Then once you get to your summation, this one you add. Right? Once we had, we put them on the second column. Once we put on the second column, what are we going to be getting there? It is normally called the total cost of the machine. The total cost of the machine, we put it down there. We take the summation of the cost of the machine plus the additionals of the incidental costs, we get the total cost, right? Now, when we have the replacement of a machine, now this part plays key role. So let us have that part. I think I'm very clear. I'm not hanging. So in this scenario, we are going to be lessing, or we less the cost. We normally less the disposal value of the old machine. The disposal value of the old machine. We less it here, right? Then from there, we normally calculate the tax on gain. Stock loss on disposal. So what is normally considered here? We normally consider the following. One, let us take the disposal value. The disposal value of old machine. The disposal value of the whole machine, we put it there. Then we let the NPV. Net book value, right? We let the net book value of old machine. Of the whole machine, right? We let it there. Then what you are going to be getting there should be the value which is supposed to be multiplied by the tax rate. So the tax gain, stock loss, or disposal, right? Right? If it is a gain, what are we going to be doing it? A gain you normally add, and a loss we normally subtract. A gain you normally add, a loss we normally subtract. What are we supposed to be getting down here? It is normally called the net cost. The net costs of the machine. And you are going to be getting it down there. Then what do we normally do? The last aspect and the last thing that is supposed to be compared. And I said, this part is only applicable under the disposal. Disposal of a machine. If we don't have the disposal, then this is irrelevant. When you read your question and you find it does not have any disposal, this part is irrelevant, right? Then we talk about investments in working capital. The investment in the working capital. What is a working capital? It is the difference between the current assets minus the current liability. That is the difference between the two. So when we get, what we normally get here, it is our working capital. The difference between the current asset and the current liability, you are going to be getting the working capital. And we normally add it here. Once you add the two, we are going to be getting, right? We are going to be getting our initial outlay. This will be our initial outlay. That will be your initial. They have said, once you had the two, the net cost of the machine together with the investment in the working capital, we are going to be getting your initial outlay. You get your initial outlay. I think I'm clear up to that point. I'm clear up to that end. If I have someone, please give me 1 minute. 1 minute, 1 minute. One of my gadgets is switching off. So 1 minute. So you can use that time also to copy. Thank you. Know that we can now be able to copy and we can be able to continue. I just want to do one illustration so that we can be able to understand our formula is mostly applicable. But before then, we just need to be able to do on the other methods, which are basically used in the computation of NPV. So let us go there. The second method basically used in the computation of the NPV should be what? For those who are able to remember, our second method should be what? We said we have two things which are supposed to be put into consideration. Once we finish the initial outlay, we are supposed to be going to our second method. And our second method should be, right? Our second method under the computation of NPV should be, someone to type there. So the second thing, which was supposed to be put into consideration, should be the computation of the annual net cash flows. The computation of the annual net cash flow. The computation of the annual net cash flows. Now, in this scenario, when you are going to be calculating the annual net cash flows, the questions are normally drafted following the two scenarios. One, annuities, or they are going to be following a format of lump sum. We normally have a lot of contradictory suggestions when we are doing our exams regarding the two. So what is an annuity? An annuity means these are the cash flows which you are going to be receiving. Similar cash flows on several times, right? The similar. So this is just like your salary. If you normally get 20,000, it is an annuity in analysis of your annual net cash flows. 20, 20, 20, 20, 12 months. Under that year, that is an annuity, right? What about the aspect of the lump sum? It means this mostly apply to the sales people. Hii mwezi anapata mshahara ya 30. Next time anapata a salary of a different figure like 40. Ile mwaka ingine, the next month anapata salary ya 50. The other day anapata 35. That is lump sum. A figure which is not similar to any other. We normally talk about once, right? It is a cash flow which is normally received once. For example, I have said 30,000. That is a one figure. Then the next month I receive 45. That is a one figure. The other month I receive 50. That is a different figure. That is what we discuss about lump sum. So when you're computing your annual net cash flows, let us look on the two, right? Let us look on the two. The type of the cash flows given. For example, the examiner can say, the project will be able to generate an annual cash flow of 6 million for the next 5 years. That is an annuity, right? But when the examiner is saying the project will be able to generate the following cash flow for the next 5 years. Each year, anakupea year 1, 20,000, year 2, 15,000, year 3, 10,000, year 4, 4,000, year 5, anakupea 1,000. That is a form of an annuity. And I just want to put it under the lump sum. So when it is lump sum, it normally looks like this. You factor your years. So your years might be 1, 2, and 3. That it means the cash flows are not the same for each year. So let us start my question from sales. So let me start with the sales. So I put my sales there for year 1, year 2, year 3, correct? Then I less my variable costs. I less my variable cost. Sometimes we can talk about the cost of sales. We less them there. Correct. Then this is the last one now. What are we going to be getting here? I know this is simple for you. We normally get contribution, which normally means this is our gross profit. This is our gross profit, correct? So our gross profit will be year 1, we are going to be getting there, year 2, then we have year 3 there. Then we less our fixed costs. We less our fixed costs for year 1, for year 2, then for the year 3, correct? Those are the fixed costs. What are we going to be getting down here, ladies and gentlemen? We are going to be getting earnings before depreciation and tax. Earnings before depreciation and tax, we less them here. Right? We less them there. Then we less our tax. We less our tax. Most probably before Ruto adds another one, we know it is 30%. So this one we are going to be deducting. It will be 30% of the earning before depreciation and taxes. So we subtract them there, right? I'm using the shortest method. Then later on, we normally add something called depreciation tax shield. I'm using the shortest now. So how do we normally calculate our depreciation tax shield? Correct. So the depreciation tax shield is normally calculated like this. You normally take the cost of machine. Let me just use that one, right? Minus scrap value, right? Then we divide it by the number of years. We divide by the number of years of the project. Then we multiply by tax rates. Let me just put 30% there, the tax rate. What you're going to be getting, we add it for each year. Year 1, year 2, year 3. Najua kuna question which was brought using the longer, the other method, but that one I will be able to consider it when we are doing an illustration. So what we are getting down here is our annual net worth, the annual net cash flows. So how does our net cash flows? I will take the earning before depreciation and tax. I subtract the tax. Then I add depreciation tax sheets. I get my annual net cash flows. I get my annual net cash flow. That is how you normally compute your annual net cash flows. Your annual net cash flows. I said factor the annuity aspect and the lump sum. Those ones should be very crucial in your computation of the questions. Someone to tell me, Mwalimu, I have finished copying so that I can move. Mwalimu, I have finished copying the question, copying the format. Mwalimu, I have finished. Someone to type. Am I alone? Hello? Who is around? Let me check. We have Chacha, we have Irene, I can see Rose, Sarah, I can see you. Terilyn, I don't know whether I'm pronouncing it correctly. Someone should be telling Mwalimu I'm with you. And our chat box. How are we together? So that I can be able to introduce you to the last method basically used. I know you have already copied. And if you are copying, I know you are at the last bits. All right, someone has said hi. Let me see. Terry is saying we are together. All right, what about others? Ameenda kupika ugali. Right. So the last one, let me just grab the upper part. I know you are copying and following. Let me just wrap there. So you can just copy, right? Someone else has greeted me with that person. Let me see. Okay, we are done, Mwalimu. That is Irene. Chacha done. What about the others? Correct. The third one and the last one, we normally do our terminal cash flows. Terminal cash flows. And in the terminal cash flows, remember very well that this is a period when you are going to be terminating the project. I just want you to understand at that point, we are going to be terminating our project, right? Now, in this case, the following aspects are normally considered, right? What do you normally consider? You normally take, if you have already, you are replacing a machine, you normally take the scrap value of new machine. What is the scrap value of the new machine? You put it there, right? Then you normally less, right? The scrap value of old machine, the scrap value of the old machine, we normally subtract it here. Then what do we normally do at the end? We normally add investments in working capital. Someone to remind me how we said we are getting our working capital and our chat box. So we add it there. What we are getting down here should be the terminal cash flow. Terminal cash flow. How did we say? We said we calculate our working capital. So we put it down there. We put it there. That is how we normally calculate our terminal cash flow. The three are mostly considered. Okay. So let me see. Very good question from Ali. Or Ali, I don't know whether I'm spelling the question right. When we are going to be doing, or I will be able to give you a scenario when we have the depreciation. Yes, the depreciation should be calculated for both machines, the old and the new. And then I will be able to show you how are we supposed to be dealing with that case. That one will be handled when we are dealing with the when we are dealing with the replacement of the machine, I will give that scenario and answer the question as we do it. I will for sure. Now, I just want to give you a scenario here. When you are doing a question, when you are doing your questions under investments, so I just want to put this under NB. When you are doing these questions, right, under the investments, when you are doing our question under investments, investment under risk, and uncertainty. When we are doing our questions under these criteria, right, and the question is silent, right, always, unajua examiner normally says, anakupeanga swali, akuambii ucalculate NPV. So in this case, na amekuambia under the requirement, advise the company, right? We normally say, always advise, right? Always advise using NPV if the question is silent. If your question is silent, it is very important you do your NPV to determine it. So if the question is silent under the risk and uncertainty, never forget that point. Never forget that point. Never forget that point. Never forget that point. So allow me to do one question and then we call it a day. Then we meet tomorrow. We continue with our interesting topic. So in this case, I want us to do a question which they tested on November 2017, question 1B. I will start from that one so that we build a base of understanding. So let us start from that point, November 2017. I know that we have our link. Who has our link and share to share with our students? November 2017, I forgot to do that. The link of the question number 1B. But because I know that you have done CPA for some time, Chacha answered my question. To get the working capital, we normally take the current assets minus the current liabilities. That one will be assisting Dennis, who is joining us now. Good evening, Dennis. Good evening, Dennis. Is Dennis able to hear us? So for the person who has opened the WhatsApp, I request you to share the link. To share the link, the question, for the questions. So mine is still here. Let me check. Someone has unmuted. Request you mute. So I have said 2017. And this should be November. Who is willing to read our first question of the night? I have said it should be question 1B. The NPV questions inakujanga pale mwanzo to scare students. And that is also the question for the last semester. Someone to read, please. Who is willing to read for us? Someone to read, please. Let me choose someone now. I will choose Cecilia to read for us our first question. Can you be able to see my question?
Yeah.
Can you read, please?
Viwanda Limited is considering purchasing a machine at a cost of 40 million shillings. The company will incur an additional 20 million shillings to modify the machine for special use. The machine is expected to have a useful life of 3 years and a scrap value of 15 million shillings after 3 years. This investment will require an increase in net working capital of 2 million shillings at the beginning of its useful life. The additional investment in working capital will return to normal at the end of the machine's useful life. The machine's purchase will not affect revenues, but it is expected to save the company 25 million shillings each year in before tax operating costs, mainly labor. The corporation tax rate is 30% and the company's cost of capital is 10% required. Advise Viwanda Limited on whether to buy the machine. Suppose the firm management is unsure about
Sorry. Let me cut you. Number 2 is not ours for today. It will be ours for another subtopic. Okay. Thank you so much. You can see our question is silent, but the examiner has given you a leeway on how you're supposed to be tackling the question. You can see he has told you, Viwanda Limited is able to purchase a machine at a cost of 40 million. For those who they don't have the question links, I have shared on our WhatsApp group. So you can be able to open on your gadgets and we will be able to flow together. So the company will be able to incur an additional cost of 20 million to modify the machine for special use. So the machine is expected to have a useful life of 3 years and a scrap value of 15 million after 3 years. The investment will require an increased net working capital of 2 million, right? Every time you'll be able to see examiner giving you the annual saving before pre-tax costs, we are supposed to be understanding that the figure, for example, he has told you the investment will require an increase in the net working capital. So already that is the investment in working capital. They have already subtracting the current assets and the current liabilities. They have given you 2 million. So the additional investment in working capital will return to normal at the ends of the machine useful life. But the machine purchase will not affect revenues, but it is expected to save the company 25. I will be able to say, when Chacha is going to buy a shirt of 1,000, he has a budget of 1,000, you go to the market, you buy a shirt of 500. Then the other 500, because you had a budget for 1,000, the other 5 becomes your earning before depreciation and tax. That is your saving. So that is what we normally call it, the annual saving pre-tax costs. Now, in that case, you can see the examiner has not given you much as our format, but in this case, he has given you 25 million each year in before tax operating costs and mainly labor. So the corporation tax rate you have already given, which is 30%, and the company's cost of capital, you are being given 10%. So examiners told you to advise Viwanda, they are very silent. And we have said, when they are silent, compute NPV. Let us do so. Let us go to our board. So in this case, when I want to compute our NPV, I will start with number 1. We said, let us calculate our initial outlay. And when I was reading my question, I have not had an area where we are going to be replacing a machine. So my question is very simple. Can I put in our shillings into thousands? Then I go and I open my question. Let us do so, please. Open your question so that you can be able to flow together. So from where the question starts, let me just go slowly. Where the question starts, we are being told by this examiner that the cost of the new machine, we are being told the Viwanda is considering purchasing a machine at a cost. So the cost of the machine is how much? the cost of my machine, I'll be given 40,000. That is the cost of the machine, right? But that is not the end. We are being told the company will require an additional. That is why I say add incidental costs. Add incidental costs. And we are being given only one, right? In this case, we are being given modification. Modification costs. So our modification cost we are being told is how much? Our modification cost is 20,000. Right? So what is our total cost of the machine? The total cost of my machine, the total cost of my machine will be 60 million or 6,000 in our case. So when I was reading my question, I have not had an area where we are replacing our machine. So what are we supposed to be doing? We say, let us add investments in working capital. Let us add investment in working capital, right? And we are being given in paragraph 3, where we are being told this investment require an increase the net working capital of 2 million at the beginning of its useful life. 2,000 here, right? So what is the total cost of the machine? What is our initial outlay? Now you'll be able to outline it that our initial outlay is 62,000. Can you see even you're not struggling? You are not struggling when you're calculating your initial outlay based on the understanding that you have. I know you are copying very well. You're not having any difficulties. When you have a difficult point of understanding, nieke pale kwa chat, I straight away consider your question. Number 2, we normally calculate my annual net cash flows. My annual net cash flows. And I said, when I'm computing this, I'm going to be factoring only 2 things here. Whether my question is being set under the annuity aspects or lump sum. And when I see it, my question is following the annuity aspect. How? How am I able to identify it? I can see not paragraph 4 or 5, yes, no, paragraph 5. We are being told the machine's purchase will not affect revenues, but it is expected to save the company 25 million each year. So it is going to be saving us 25 million every year in before tax and operating costs, mainly labor. So for 3 years, this one will be saving us 25 million. So in this aspect, I will be able to put my years in this manner, 1 to 3 years, right? We are going to be saving how much? Let me just put these in thousands of shillings. Examiners told you very clearly that you are going to be saving 25,000 each year. So how am I going to be putting this? Correct. Very simple. I'll be able to say, right? I'll be able to say that we have our annual pre-tax costs. My annual pre-tax costs, which are my annual earnings before depreciation and tax. I'm being given 25,000. 25,000. Right? Then we said, when we are using the shortest formula for the computation of the annual net cash flows, you just come here straight away, you less your tax. The rate you are already given 30%. 30% of this translates to around 7,500. Najua sisi ni mathematicians. This one does not require us to use a calculator, right? Then the last thing that you're supposed to be adding here, add depreciation tax shields. Depreciation tax shield. How are we getting our depreciation tax shields? Someone? How do you normally get our depreciation tax shields? Someone to remind us. How are we getting our depreciation instructions? Please type there. Type on our chat box. Someone on our chat box. How do you normally get the depreciation instructions? I think my good students have forgotten. So to get the depreciation tax sheet, you normally take the cost of the machine minus scrap of the machine, the scrap value. You divide it by the number of years of the project, right? Then you multiply by what? By 30%. So what is the total cost of the machine? When I look up here, the total cost of the machine is 60,000. What is my scrap value? Let me go back to the question in paragraph 2. We have been told the machine is expected to have a useful life of 3 years and a scrap value of 15,000. So I just take it straight away. The project we have been told, it carries 3 years. Then at the end of the day, I multiply here by 30%. I multiply there by 30%. I multiply there by 30%. So how are we getting this? So you just need to take 60,000 first, minus 15,000, divided by 3 years. Then you multiply by 0.3. I can see I'm getting 4,500. 4,500. So what is my annual net cash flows? So my annual net cash flows, I'll be able to take my pre-tax costs, right? Plus the minus the tax shield, the tax rates, right? Or the tax value. Then we add our depreciation tax shield. So I just need to take 25,000 minus 75,000 or 7,500 plus 4,500. And I should be, Chacha, I know you have gotten 22,000. 22,000. We are supposed to be getting 22,000. 22,000. So what is my third and the last stage in the computation? Number 3, we said calculate your terminal cash flow. Terminal cash flow. So in this case, I said my Kenya shillings into thousands of shillings. So even I don't now need to use the question. What do I need? I just need to follow the format. We said, let us take the scrap value of new machine. We don't have. Do you have the scrap value of the new machine? Someone to tell me, do we have it? We say yes, we have it. Because already we have 15,000. Then we less scrap value of old machine, which we don't have. So this is kupe wasiwasi. Then lastly, we add investments in working capital, investment in working capital of 2,000. So how much are we getting here? How much are we getting as our terminal cash flow? How are we getting as a value for the terminal cash flow? In my case, I'm supposed to be getting 17,000. I will be able to get 17,000. The value for the terminal cash flow, 17,000, 17,000, correct? Now, you can be able to ask Mwalimu, now after the computation of this, there is no any area we have said that this is the answer for the NPV. And I will be able to say, to compute your NPV, we say under the definition, we take the present value of the cash inflow. It's normally written like that. Then we subtract our initial outlay. So what we are mostly determined, it is a computation for the present value of the cash inflows, so that we can be able to subtract our initial outlay. How are we going to be doing so? So I said that once the years are in these scenarios, how am I supposed to be doing? I just need to take my years, I factor my cash flows, correct? We factor our discount factor. The cost of capital is given in the question. I remember we are being given. Let us see here under the question so that I can read for you. Under note number 10, or not the last one, we are being told that the corporation tax rate is 30% and the company's cost of capital is how much? Is 10%. The cost of capital already we are being given is 10%. So the discount factor is 10%. So what are we going to be getting at the end of the day? Our present value. We are going to be getting our present value. Correct. So in this case, I will be able to write my years in this manner. There is a cash flow which we have generated for the 3 years. Then there is another cash flow which we are going to be getting at the end of the year. We said we terminate our project under the end of year. So this 17,000 will be received once at the end of the project. Will be received once at the end of the project. I want us to understand at that point. Will be received once. But from year 1 to year 3, our annual net cash flows will be 22,000. So what are we supposed to be doing here? Simple, very simple. So in this case, I just copy my cash flows. Here we have 22,000. What about the year 3? We are going to be getting 17,000. So here is where now this concept comes in. We have to be determining, because already nikiangalia kwa the back of our question papers, every semester, examiner lazima akupe tables. So which table am I going to be using under which circumstance or scenario? So I just want to differentiate this. And I say, when you have this scenario where the cash flows are going to be similar for specific years, this is our annuity. Right? Then when we have these specific years generating different cash flows, we say this is our lump sum. That is our lump sum. And I want just to put an attention here. Sometimes the questions normally comes without with a different rate, which is not existing in those tables. Those scenarios will ever come one day. So if they come when you are doing the exams, so for annuity formula, which we normally call it, the present value interest factor annuity, R% N year. These are the basics in Lisoma Mahali, right? The formula for these is always 1 minus 1 plus R raised to a negative N, you divide by R, correct? Why am I teaching you this? I have said there are times when this rate is not existing on those tables. That is the time we will not be able to calculate your discount factors. Now, what about when we have lump sum? And the lump sum, we normally write it like this: the present value interest factor, R% N years. And the formula for these is always 1 plus R, we raise for a negative what? We raise our negative N. Mimi, I will use the formulas. Where would I know ukaangalie huko? Utaenda ukaangalie huko kwa table if they are the same. So the tables for the annuities, I just want to make these clarifications earlier. The tables for the annuities ni zile ziko na bigger percentages, bigger decimal points. For example, 10 points, something, 3 points. Those are the annuities table. Ile utaiona iko na bigger decimal points. Here is for the annuity. The one with the 0 points, the table with the 0 point something, those are for lump sum. Now, remember my discount factor, which is my rate. is 10%. So when I'm using my formula, I'm going to be using what? 1 minus 1 plus 0.1. I raised for a negative. How many years of our project? We have -3. You divide by 0.1. Then when we are using the lump sum, we normally take this 1 plus 0.1. We raise for a negative what? So let me start with the last one. 1.1, because that's addition, that is what you are going to be getting. 1.1, I raised to power -3. We are raising under something on your calculator looking like that. There is a button which looks like this. So what I'm getting is 0.7513. Let me just write here. I know that is not visible. 0.7513. What about the upper one? So I say my answer, which I've already gotten here, ni aka kapat. You see that? So I just say 1 minus my answer, then I divide by 0.1. I'll be able to get, and I know that is what you're going to be getting on your tables, 2.4869. Go on your tables, we'll be able to get that. And always when you're doing the computations, make sure your decimal points are always 4. Even in your table, they are always 4. So don't write 2, they are always 4. Now, in this case, let me just copy them here. For the annuity, we have said the first is annuity, 2.4869. What about the second one? We have 0.7513. Do your multiplication between your cash flows and the discount factors to get your present values. Let's start with the first one, times 22,000. I'm getting 54, and I will just be able to round off 54,711. Correct? 54,711. Then the second one would be 17,000 times 0.7513. What I'm getting is something closer to this, 12,772. What am I getting here? It is normally called the present value of the present value of the cash inflows. Sorry, the present value of the cash inflow. That is the term which I was forgetting. So 12,772 plus 54,711. I'm getting 67,483. I know, Chacha, you are getting that. Then we said, let us less your what? Your initial outlay. So how much was our initial outlay? I remember it was half here, but I have not wrapped it. It was 62,000, our initial outlay. So I subtract it here, 62,000. So when I subtract it, what I'm going to be getting here should be my NPV. So 67 minus 62,000, we are getting 5483. 5483. 5483. 5483. That is what I have gotten as my NPV. Have I answered my question? I will say I have not. Why? Because my question does not ask me to calculate the NPV. The question is asking you to advise the company, advise the Wanda Limited on whether to buy the machine. And you are saying, you just come here straight away and you say, under the advice, we say the NPV normally have 3 acceptance criteria. Correct? So we say if our NPV is positive, accept the project. If it is negative, reject. If it is at 0, we say it might be accepted. So how does it happen on our case? I say, under my advice, I should say, Viwanda Limited, because they wanted to buy the machine, Viwanda Limited should buy. Viwanda Limited should buy the machine. The Viwanda Limited should buy the machine. Viwanda Limited should buy the machine. That is advice we are supposed to be giving under that kind of a question. Any question so far? Any question?